Good afternoon, everyone. This is Rich Lowry. I appreciate you tuning in. I'm going to give you an update on where things stand at the moment as far as risk managed equities and our active fixed income strategy. And then a couple of things to expect as we move ahead. So let's share my screen. Sure everybody's going to read this very closely. So we're going to go through the account review, look at performance and risk versus a benchmark. We're introducing a new risk assessment tool from Orion. I'll give you an update on where things stand in the economic cycle, what to expect as we look ahead, and then next steps. As far as performance, risk managed equities, which we're now calling all asset. It always has had the ability to invest in all assets. We named it risk managed equities. Looking back, I'm not sure exactly why, but we're going to start calling that the all asset strategy. It's up 4.11% year to date. I put a couple of benchmarks on here so that you can see the difference in terms of risk. The all asset strategy has a beta, which is a measure of risk of 0.22. The Vanguard Balance Fund, which would be comparable in terms of its risk objective, is 0.66. So if you adjust the Vanguard strategy for the same level of risk as all asset, it creates an even larger performance gap. So we would say that on a risk adjusted basis, the all asset strategy is doing even better than what's posted year to date. The Orion risk score, which uses a scale of 1 to 100. So the S&P is an 88. Just so you have kind of a reference point, the Vanguard Balance Fund is a 48 and the all asset strategy is a 20. So it still is low risk. You may note that we've added risk in the quarter, but still consider that conservatively positioned. The active fixed income strategy, which we call AFI, is up 167 on the quarter, and the aggregate bond index is negative. That also has a pretty low risk score, whether you're looking at beta or the Orion score. I'm going to update you on where we stand, where things stand in the economic cycle. Growth is still below trend, still is not recessionary. And because the recession hasn't arrived by now, doesn't mean it's not coming. It just means that this cycle is taking longer to play out than prior cycles. We are seeing signs that employment is beginning to weaken. Probably the biggest call out this time relative to the last couple of quarters is that the Treasury has overtaken the Fed as being in the driver's seat. They hopped in the driver's seat, threw the Fed in the back seat. And if you think about what's going on, the Fed is on autopilot. They haven't changed rates. Nobody's expecting them to increase more. Market gets all excited about possible rate cuts, which we don't think are going to happen. And quantitative tightening, or QT, has been on autopilot. So at the margin, there's no change. There's no surprise factor involved with that. And instead, the Treasury has a boatload of debt to issue. And lately, last quarter and into this quarter, have been issuing T-bills. And without getting into the weeds, if you sign up for the Zoom, we can get into the weeds if you want. But when they issue T-bills, it doesn't impact liquidity. When they issue bonds, it does. And the fact that they were issuing bonds and they pulled back on that substantially to issue bills has been a positive inflection in terms of liquidity. And based on market performance year to date, and really since last quarter, markets are pricing in virtually no probability of a recession. If you look at option implied probabilities, they're in single digits, like 6 or 7% probability of recession. And our feeling is it's quite a bit higher than that. So let's run through some updates from last quarter. This is the aggregate coincident index, and you can see that it is well below trend and weakening compared to where we left off last year. Retail sales remains weak. Retail sales has been revised down in the last two periods, from up here to down here, and from up here to down here. We'll see what happens with the most recent. But retail sales, real retail sales, is not painting a robust picture. Industrial production remains weak. And as far as employment, which is really the last thing to go, it's always the last thing to go. And the question is, are we going to follow the typical script? If you break it down and look at leading employment, this does look like it's following the script. So we have 2008 and 2001 in dotted lines, and a composite of the last 5 recessions as a solid blue line. You may remember this picture from last time. After ticking up a little bit, this is now moving back down. So this looks fairly normal. This looks stronger than normal. This is coincident employment. So moving back, as long as leading employment is trending down, you would expect that eventually coincident employment is going to turn down. And that really has yet to happen in any meaningful way. It looks like we're kind of flatlining across here. This dotted line here is 2008. So just because we're above the composite of the last 5 recessions, just means that this cycle has shown more resilience as far as the labor market goes. Jobs hard to fill, according to the National Federation of Independent Businesses, is now declining at an accelerating pace, and this would be new cycle lows. NFIB hiring plans is now hooking back down and is also at cycle lows. This leads jobless claims. And if you put the two together, this would indicate that jobless claims are about to pick up. The Kansas City Labor Market Conditions Index is a broad-based measure, incorporates 24 different variables. It too is declining. And if you relate that to jobless claims, that also looks like it's poised to start moving back up. If you break out the aggregate index into its components, 3 of them are contracting, 3 of them are showing resilience. The 3 that are showing resilience are all somewhat related, and that is income, spending, and employment. And as employment starts to decline or jobless claims start to increase, then that has a relationship to pulling down income and consumption. Really, the big news from last quarter is how the Treasury pivoted away from selling long-term bonds to issuing bills. And again, without getting into the weeds, when they issue long-term bonds, it pulls out bank reserves, liquidity contracts. When they issue bills, it has no impact on liquidity. And this was basically October 31st when they made that announcement that they were pulling back on issuing long-term bonds and instead issuing bills. And financial conditions eased the fastest pace on record. That's really the main catalyst behind the market bounce from October 31st till now. And the question is, how much longer can can the Treasury kick the can down the road by issuing bills instead of bonds? It's a matter of time. They'd probably try to get through the election without issuing a lot of long-term debt, but there's still a lot of long-term debt for them to sell. Term premiums also collapsed during that same period of time and are now back to being negative, which is another way of looking at easy financial conditions. Don't worry if you can't read this. This is the global risk matrix. Many of you may be familiar with it, but I would be happy to get into the details if you sign up for the Zoom. But generally, if you look at behavior across 42 major markets, equities are generally bullish. Volatility is neutral to bearish. Commodities are broadly turning bullish. US dollar is bearish. Other foreign currencies against it are bullish. Credit spreads are falling, and global bond yields are neutral to bullish in a couple of cases. If you had to characterize this kind of market behavior, it looks like quad 2, but there are an awful lot of neutral signs on here, and neutral means those markets haven't made up their mind yet. So we would call this a low conviction quad two. If some of the neutrals start to show their hand, it can increase confidence that we have quad two for the time being. But until that happens, we'll continue to treat this as a low conviction quad two. In terms of what to expect going forward, bank credit is now contracting. It's been a matter of time before rates went up, before that translated into bank credit contracting, but that looks to be happening now. We expect the Treasury will continue to dominate the Fed, but they can't keep issuing T-bills indefinitely. If you add that up, it means negative outlook for long-term bonds, 20 and 30-year bonds, as opposed to short-term bonds. Recession odds have decreased, but they are still higher than what the market is pricing in. If the market's pricing in a 6 to 7% probability of recession, I would take the over on that. Valuations and investor positioning suggest that forward returns are likely to be subpar. And then CPI has plateaued and reaccelerated for 2 periods in a row. That's consistent with our view for all of the last year and a half, that the Fed is going to maintain rates higher for longer. And as the year progresses, I wouldn't be surprised to see rate cuts get priced out of the market. We came into the year where the markets were expecting 6 rate cuts, and now it's down to 2. And the 2 are probably going to be back half of the year. And if we get more CPI reports that show reacceleration and confirm that this plateau is uncomfortably above the Fed's target, I wouldn't be surprised if we see those go away. Here's a picture of credit contracting. This is now negative, and if you look across the page, other periods where it's gotten there have been associated with recessions, which are the gray bars. Part of the reason that the Treasury issuance is such a big deal is we have, number one, massive budget deficits that the government has to finance, and the central bank is not buying them. And this shows commercial banks are not buying them. These are unrealized losses from treasuries that commercial banks bought in 2021, 2020, 2019. And with the sharp increase in interest rates, banks are sitting on an enormous amount of unrealized losses. So they're effectively not buying. The Fed's not buying. That leaves folks like you and us to take up the slack and buy the massive amounts of treasury that they're issuing. And because of that supply-demand mismatch, we're expecting that to keep upward pressure on long-term rates. There's a maturity wall that is approaching. The maturity wall just looks at how much debt comes due in the next couple of years. Although a lot of debt has been refinanced, there's still a significant amount that does have to get refinanced over the next couple of years. If you step back and look at valuation relative to forward 12-year returns, that's what this data plots. And then over here is where we are currently. So field position is not good for anybody expecting, average to let alone above average stock market returns over the next decade or so. And same thing with positioning. Households are now back to being kind of max weight in equities. And if you correlate household positioning against forward returns, this indicates that stock market returns are going to be well below average. Here's a picture of CPI. We put a bottom in here. Last 2 reports have picked up. And the 2 reports before that didn't show CPI accelerating, but the underlying measures of CPI began to telegraph that 3 and 4 months ago. In terms of our current positioning, the all asset strategy has a pretty broad mix across all assets. A couple things to notice from last time is T-bills went down, equities has gone up. We do have some bond positions that are focused in that 2 to 7 year maturity. And then we have a hedge that's going to protect us from long-term interest rates going up. So if 20 and 30-year rates go up, this is going to make money for us. And then we have, commodities. Gold has been working well for us. We have that in the currency bucket. And fixed income has some similarities. So it also has gold. It also has exposure in that 2 to 7 year. It also has a hedge to protect us from 20 and 30-year yields going up. One thing I want to point out here, this hedged junk, I couldn't think of a better name for it, but basically this is a fund, an ETF, that takes the junk bond market, the high yield market, sorts it in terms of relative strength. It buys the top 20%, and then against that, it shorts the bottom 20%. So it's kind of an oxymoron to say higher quality end of the junk bond market, but there is a such thing. So this is picking up some yield for us, but it's hedged in that high yield typically doesn't do well in a near recessionary environment, and that's what this hedge is really for. As far as next steps, I hope everybody clicks on the link to sign up for a Zoom. On the Zoom, we'll go through individual account performance. We'll send an Orion risk assessment. We would like to see an update. It's been a while since we had everybody updated. It would be interesting to see what your risk score is, and then we can get into comparing that to how the all asset strategy and the active fixed income compare. And then Park Edge is rolling out several new investment strategies this year. And once we get the risk assessment back, we'll be able to talk in terms of how any of the new strategies might relate to your individual situation. So thanks for tuning in. Look forward to connecting with you on the Zoom. Thanks a lot.